interesting start, 3-1 advancing to declining stocks, but it's faded. Not so over in China, where they just had one bonsai morning over there, 4% increases. Look at this in the Shenzhen. We're still down 30%, by the way, in the Shenzhen. Shanghai still down 20%, but very rare to get 4% moves in the indices of these sizes. These officials over in China are giving new meaning to jawboning the market. I mean, everyone and their mother was out since Friday talking about how strong the Chinese stock market. The president was out offering unwavering support for non-state firms. Those are the smaller guys. The heads of the exchanges were talking about helping them people manage their risks. A lot of money put up for loans. There's been income tax cut proposals that are on there. They're doing everything they possibly can to keep the markets supported over there. And at least today, it definitely had an impact. As for here, I think it's very clear a few things you want to watch for the bottom, as we used to call about it. Number one is lighter volume. After a couple of weeks of way heavier than normal volume, particularly selling volume, that was happening towards the end of last week. You want to see a pickup in short-term indicators. I mean things like 10-day moving averages, stochastics, technical averages, and only about a quarter of the stocks are above their 10-day moving average. It was as low as 10% a week and a half ago, so that's improving a little bit. And finally, less volatility, specifically with the VIX curve flattening. You want to see the front-month contract, the cash contract, not dramatically elevated like it was a week and a half ago, 28, and the contracts in the month ahead at 18. They're flattening out, and that's another sign that at least it's calming down a little bit here. As for sectors today, the right stuff moving here, the stuff that was beaten up most, the emerging markets, for example, your semiconductor, SMH, those are two bellwethers, and consumers are up. We've got the retailers moving. Jim's right about energy. That's doing nothing here right now. And if you look at the Halliburton numbers, it's very interesting because even though they beat on the top and bottom line, they talked about customer budget exhaustion. That's a very interesting phrase. Even though they said that was short term, that was the phrase that kind of got passed around. I think that was a factor in the fact that Halliburton is trading lower right now. By the way, they're right near 52-week lows. As for earnings, you know, Kimberly-Clark is a very good example of what companies are facing right now. So a stew of good and bad news. So organic sales growth, 1%, not bad for Kimberly-Clark. And selling prices were higher. They made a point about that. This is all good news here. But we have that, of course, the comment on foreign exchange. We're seeing on all these multinationals are hurting their growth by 1%. And then, of course, the comment about input costs being higher. They did affirm their full-year earnings and they're above consensus. But we have this stew of good organic sales growth and higher prices offset by foreign exchange issues and higher input costs. I think that's your theme. And the question is, how much margin erosion are we going to see at this point? That's what's hard to figure out right now. But it's not bad, but it's increasing. So instead of 1% costs, maybe it's going up 2%, in some cases 3%. In some cases, it's being offset by higher prices, so the revenues are going up. So again, it's not the same for every company, but it's a complicated stew, as you see Kimberly-Clark down a little bit. Finally, predictably, they were attacking peak earnings growth. Now we're talking about peak revenue growth. This article in the Journal today. I'm not that worried about it right now. Just bear in mind, we had this outlier 9% number in the second quarter for revenue growth in the S&P 500. We're going to do above 7% for the third quarter, 6.6, 6.8 going into 2019. Remember, the historic average in the last decade is 3 to 5%. We had negative revenue growth in 2015 and part of 2016. So these numbers are well above that. As long as I'm more concerned about the cost factors. If you have 2% growth in costs and you're getting 7% growth in revenue, that is at least manageable, particularly with the price hikes. When you start reversing that, then you have problems. So watch the input costs. Right now, guys, we are now negative in the Dow after starting 3-1, positive to negative. Guys, back to you.